Bitcoin burst onto the scene in 2009, a year that would mark the beginning of a new era in the world of finance. It was a time when the global economy was reeling from the aftermath of the 2008 financial crisis, and trust in traditional financial institutions was at an all-time low. People were desperate for an alternative, a way to take control of their own financial destinies without relying on the very systems that had failed them so spectacularly. Enter Bitcoin, shrouded in the mystery of its pseudonymous creator, Satoshi Nakamoto. This enigmatic figure, or perhaps group of figures, introduced a revolutionary concept: a decentralized digital currency that operated independently of any central authority. The allure of this new form of money was immediate and powerful. It promised a way to bypass the traditional financial system, to conduct transactions directly between individuals without the need for banks or other intermediaries. It promised a financial revolution, a world free from the shackles of central banks and government control. For many, this was a dream come true. The idea of a currency that was not subject to the whims of governments or the manipulations of financial institutions was incredibly appealing. It was a vision of financial freedom, of a world where individuals had complete control over their own money. Bitcoin enthusiasts envisioned a decentralized utopia where transactions flowed freely, unburdened by fees and intermediaries. They saw a future where anyone, anywhere in the world, could send and receive money instantly and securely, without having to worry about exchange rates, bank fees, or government regulations. It was a vision of a truly global economy, where financial barriers were a thing of the past. The allure was undeniable. Bitcoin's decentralized nature meant no single entity could manipulate its value. This was a stark contrast to traditional currencies, which could be devalued by governments printing more money, or by economic policies that led to inflation. With Bitcoin, the supply was fixed, and the value was determined solely by the market. This created a sense of security and stability that was very attractive to many people. Transactions were secure, transparent, and recorded on an immutable public ledger called the blockchain. This technology was revolutionary in its own right. The blockchain ensured that every transaction was verified and recorded in a way that could not be altered or tampered with. This created a level of trust and transparency that was unprecedented in the world of finance. It meant that anyone could verify the authenticity of a transaction, and that the entire history of Bitcoin transactions was available for anyone to see. Early adopters, drawn to its libertarian ideals and potential for astronomical returns, rode the wave of its meteoric rise. These pioneers saw Bitcoin as not just a new form of money, but as a movement, a way to challenge the status quo and create a more equitable financial system. They were willing to take risks, to invest their time and money in this new technology, because they believed in its potential to change the world. But as with any revolution, the fervor often masks a darker reality. The rapid rise in Bitcoin's value attracted not just idealists, but also speculators and opportunists. The promise of quick riches led to a frenzy of investment, with people pouring their life savings into Bitcoin in the hopes of striking it rich. This created a volatile and unpredictable market where prices could soar one day and plummet the next. The promise of decentralized money, while seductive, has proven to be a siren song, luring investors onto the rocks of speculation and financial ruin. Many people who invested in Bitcoin during its peak found themselves facing significant losses when the market inevitably corrected. The dream of financial freedom turned into a nightmare of financial instability, as the value of Bitcoin fluctuated wildly and unpredictably. The time has come to peel back the layers of hype and examine Bitcoin for what it truly is, the biggest financial scam of our time. While the technology behind Bitcoin, the blockchain, has undeniable potential, the reality is that Bitcoin itself has become a tool for speculation and manipulation. It has failed to live up to its promise of creating a decentralized financial system, and instead has become a vehicle for financial exploitation. As we move forward, it is crucial to separate the promise of the technology from the reality of its implementation, and to approach Bitcoin with a critical and informed perspective. At the heart of any sound investment lies intrinsic value, the inherent worth of an asset based on its underlying fundamentals. Intrinsic value is what gives investors confidence that their investment will hold or grow in value over time. It is the bedrock upon which traditional investments are built, providing a sense of security and predictability. Gold has intrinsic value. derived from its industrial applications and historical role as a store of wealth. For thousands of years, gold has been used in electronics, dentistry, and jewelry, making it a tangible asset with real-world uses. Its scarcity and the effort required to mine it further contribute to its value. Stocks have intrinsic value, representing ownership in companies that generate earnings and dividends. When you buy a stock, you are essentially buying a piece of a company, entitling you to a share of its profits. This connection to real-world business activities and financial performance provides a solid foundation for the stock's value. Bitcoin, however, possesses no such foundation. Unlike gold or stocks, Bitcoin does not have a physical form or generate income. It is a digital asset, created and maintained through a decentralized network of computers. Its value is not tied to any tangible asset or productive enterprise. Its value is entirely derived from the belief of its holders. This belief is based on the idea that Bitcoin can serve as a decentralized currency, free from government control, and as a store of value in a digital age. However, this belief is not grounded in any physical or economic reality, making it highly speculative. This creates a precarious situation where the price is solely dependent on the collective faith of a fickle and often irrational market. Unlike traditional assets, which have intrinsic value to fall back on, Bitcoin's price can be extremely volatile. It can soar to new heights on a wave of optimism, only to crash down when sentiment shifts. When that faith wavers, as it inevitably does, the entire edifice crumbles. The history of Bitcoin is filled with dramatic price swings where fortunes are made and lost in a matter of days. This volatility is a direct result of its lack of intrinsic value, making it a risky investment for those who are not prepared for its wild fluctuations. This lack of intrinsic value makes Bitcoin susceptible to wild price swings, driven by speculation and market manipulation. Unlike regulated financial markets, the cryptocurrency market is still in its infancy, with fewer safeguards against fraud and manipulation. This makes it a playground for speculators, and a minefield for cautious investors. It's a game of musical chairs where no one wants to be left standing when the music stops. The fear of missing out drives many to invest in Bitcoin, hoping to ride the wave of its rising price. But when the market turns, those who are left holding Bitcoin can find themselves facing significant losses. And when it does, the losses can be catastrophic. The stories of people losing their life savings in Bitcoin crashes are all too common. This highlights the importance of understanding the risks involved and not investing more than one can afford to lose. In the end, the lack of intrinsic value makes Bitcoin a highly speculative and potentially dangerous investment. Investors should approach Bitcoin with caution, recognizing that its value is driven by market sentiment rather than underlying fundamentals. Diversifying investments and seeking professional advice can help mitigate the risks associated with such speculative assets. History has shown that markets driven by speculation are prone to bubbles and crashes. The dot-com bubble of the late 1990s and the housing market crash of 2008 are stark reminders of what can happen when market exuberance outpaces reality. Bitcoin, with its lack of intrinsic value, fits this pattern all too well. A balanced investment strategy that includes a mix of assets with intrinsic value can provide stability and growth over the long term. While Bitcoin may offer the allure of quick profits, it also comes with the risk of significant losses. Understanding this balance is key to making informed investment decisions. Risk management is crucial when dealing with speculative investments like Bitcoin. Setting clear investment goals, understanding one's risk tolerance, and regularly reviewing and adjusting one's portfolio can help navigate the volatile world of cryptocurrencies. Education and awareness are also vital. Investors should take the time to educate themselves about the nature of Bitcoin and the broader cryptocurrency market. Attending seminars, reading up on financial news, and seeking advice from trusted financial professionals can provide valuable insights and help avoid costly mistakes. In conclusion, while Bitcoin has captured the imagination of many and offers the potential for high returns, it is not without significant risks. Its lack of intrinsic value makes it a speculative asset, subject to the whims of market sentiment. Investors should approach it with caution, armed with knowledge and a clear understanding of the risks involved. By balancing speculative investments with assets that have intrinsic value, investors can build a more stable and resilient portfolio. In the ever-changing world of finance, this balance is key to long-term success and financial security.